All right, good evening, guys. Thanks for your patience. Nightly strategy podcast for Sunday night, April 24th, 2022. I was just doing some housekeeping today. Came across a couple flashcards that I thought were useful. This one takes a look at the world of relative volatility. On the left-hand side, you have the Dow 30 Industrials. That's 30 things that have real value in the world. They are actual entities. There's 30 of them. They're all the great big companies, many different sectors. And it has a certain range of volatility. I call it like that. As you move further away from reality and more towards the world of sentiment, you get out to the S&P 500, which has more volatility than the Dow, and it has 500 components, all big companies, a real sense of reality to them, but it's already taking on something like mythical proportions with all of the derivatives associated with it. When you get out even further, you have the Russell 2000, an index that represents 2,000 small caps, much more volatile. And you even have the ability to play the extra leverage of TNA and TZA, the triple leveraged instruments that are geared to the Russell. And you could get, this was back in the days when XIV was still a thing, the inverse volatility, which was not tied to any underlying element at all except for the perception of perceived risk in S&P futures contracts by the floor traders. And so that was not anchored in anything except in human psychology. And so if you're a volatility trader, you want to move more and more towards the right, generally speaking, because the moves are larger. And just recognize that you are less anchored in reality the further out you are trading on psychology rather than on the underlying fundamentals of mature businesses. So, shaping the way we think about volatility and its impact on trading. This one was a sketch we did that just reminded us that they all look the same leaving the station. You know, when it comes into the doji and takes on water and coal and lets off passengers and takes on new passengers en route across the Badlands. And then it starts pulling out. You don't know when it's leaving the station whether that's the one that's going all the way across country or just down the tracks to the next station. They all look the same, and that's why we got to take them, because you don't know. You can't know. Someone on our team asked me what I had learned from 3 years of continuous effort in the true storytelling practices of the True Storytelling Institute. Whoops, Snagit just crashed. Well, that's not good. So we'll keep talking until the screen blanks. I'll post this one in the chat room, but it really is just a profound way of understanding the world and relating to it through the use of storytelling that starts from the heart and is filled with truth and is an effort to help the people thrive as a result of the stories from our life that we can tell. This is going to be bad because I had a bunch of charts ready to show that I hadn't saved yet. That's not going to be good. Let me pause the record. Oh, there it is. Let's pause the recording for a moment. I hope they still show up when this comes back on. And I'll post this one in the chat room. It's just there's a lot of good, valuable things that I've learned in the last 3 years of almost daily practice with this. Certainly every week. I've run a couple of different true storytelling circles and have recorded some artifacts that describes what it's like to use it and to live it. I see some of the interns in here. I posted the link in Slack for you guys to be able to take that course for free. It's normally $200 for the foundations course, and proceeds go to the soccer scholarship fund, but I've made that available to you guys. Link is in Slack. This one is from the early days of COVID and advanced hybrid trading. And it was an example of some of the work that we did inside the hybrid trading course because we had lots of time because of COVID. Had to do something. And what we really did was we analyzed in detail, the logic and rules of Frog 1.0, the regular Frog, which waits for a turning point and then waits for a move off a low of a full Frog box, whereupon you take a mechanical entry, and then it trails with the Frog box. And what we found was in Frog 1.0 and its various manifestations, it was getting 0.6 R wins, which means that it had to have moved up to 1.6 maximum favorable excursion in order to pull back a full Frog box in order to end up with a 0.6 win. And we thought that was, why are we giving back more than what we're taking home? We're only getting a 40% efficiency on that, or 37.5. So we looked at some other things, like it was a rare thing for the Frog to take an entry, come all the way down to minus 0.7 or 0.9, and then reverse and then go on to get the favorable excursion. It was much more likely the case that if this thing rolled over fast, that it just wasn't going to be any good. And we said, well, what happens if we were to adjust our stop to or entry to 0.7, keep the full Frog box, so it would actually have a 0.3 buffer below the low of the turning point, and then just enter after a 0.7 move off the bottom, and then just trail with the Frog box, and it improved our numbers all over the place. And then when we looked at the top side here, we said, well, why are we giving back a full one? If we could live with a 0.7 here, maybe we could live with a 0.7 here. And what that did was, off the same set of trades, would give us something like a 1.2 average win or a 0.9 average win, depending on which of those rules you would work with. And that was a way to squeeze more value out of the same moves that Frog 1.0 was positive expectancy on, but we were finding ways to get more value. And we were able to do that because we had applied these rules so mechanically and religiously that we had a good set of baseline material that we could apply some analysis to. So that was an example of some of the work we did in the advanced hybrid course. This is one that we're working on, just trying to figure out how to account for this little trade series. So this is from the niche course being developed, the 5-minute Aussie meets the sniper. And so in this little setup, we've simplified the screen quite a bit. We've identified some particular signals, in this case associated near a PSAR flip with a small MMRB. This one pays off a 2R trade. Comes back and tests the PSAR, fails again, get the re-entry and a re-entry and a re-entry, or actually a second entry and a third entry and a 4 entry that exits on a 1, 2, 3 right here, which nets 61R from Friday. And so we're trying to figure out, not counting whatever this was. So we're trying to sort out practically whether to treat that as one 64R trade or 4 separate trades in order to better reflect the nature of the trade. And I would just note that that's a good problem to have. This came out of a coaching session with a trader a number of years ago where he was taking a look at the nature of good return days versus bad return days, and that what was happening when he was doing really, really well with the rule set, that there was a direct correlation between the numbers of trades and the R that he was producing. So he was well aligned. On days where he was getting bad R's, it turned out that the longer he stayed in, the worse it was getting. He was throwing good money after bad, trying to make up for it. So there were some psychological elements that were causing him to turn bad days into really bad days. And so we did some work on the psychology of his trading that actually ended up helping him. So my son's been working on a project for me, and what we have. Oh, I know what I wanted to do. Stand by. I wanted to explain this a little better. Oh. No, it didn't save. All right. Well, what he's got is he's building me some analytical tables that look like this, where we're taking a look at. This is just the Dow 30. And we're taking a look at a strategic level location. So we're taking a certain price that closes here, the close today, and we're looking back a strategic length of time, a long-term significant length of time, and we're finding the highest high and the lowest low during that strategic look-back period, and trying to find today's price located within that stack, and maybe it's here, and if we set that equal to 100 and that equal to 0, then today's price fits on that scale, and so Merck has a score of 74, so Merck would be approximately like right there at 74. And then we're looking at an operational time frame, which is shorter, also significant, and in that period of time, where does today's price fit on? And for Merck, it turns out to be 60. So we set the highest high equal to 100, lowest low to there, and Merck's price here turns out to be 60. So and then we're looking at the z-score of volatility. So we're taking a certain short-term time frame and look back a certain distance, computing the high to the low, expressing that as a percentage, and then comparing the percentage of this look-back period to a number of look-back periods in the past, computing the max, the min, the average, and then the standard deviation to build a z-score ladder of like 1, 2, 3, something like that, -1, -2, -3, and then using that to define a histogram of volatility, which says I really am not interested in things that are between +1 and -1 volatility. That's not interesting to me. What's interesting to me are the things that are extremely low volatility, so z-score is less than -1, and those that are very volatile already, or it's greater than 1. It is from these two areas of abnormal volatility that I'm very interested. So I think that's so important that I've sorted this column. I've sorted by that column. So the least volatile symbols in the deck right now, the ones that are only even below average in the in the Dow 30 are these. So Merck is especially quiet at -0.71. It's almost abnormally quiet. Amgen, Walmart, AXP, and Boeing. Whereas some other symbols down here, these are the ones that are all extremely volatile compared to their longer-term look-back period, the longer-term strategic volatility. And so that means things like Travelers, IBM, and Verizon are on a tear. They're more than 2 standard deviations of volatility. So we're taking a look at this stack and identifying, we've identified at least 8 different patterns that we think are going to lead to critical state trade setups. For instance, we think Merck, I'll say Amgen is an even better example. So it turns out that where was he? Amgen. Yeah, so Amgen is an interesting one. It's at a high level on the long-term index, so it's very near it's in the top 15% of his look-back period. The operational one, it's 3/4 of the way up the stack. So this thing is by every measure, everybody's pretty happy owning this thing, and the volatility is extraordinarily low. So this is like a long haul trucker who's making a long steady move. If I was doing this across country, he's making a long steady move cross country and just quietly chugging along with really low volatility and exceptional performance. And I noticed that Merck, Amgen, Walmart are all kind of in the pharmaceutical business. So that doesn't surprise me. Whereas IBM is what I call a fireworks. He's an 87, an 81, and a 2.26. So he also is extremely high on the strategic, very high on the operational, and his volatility has literally exploded. Bang, bang, fireworks, 2.6. So this thing has had an explosive move up. So that could be either more coming or like at the end of a fireworks and ooh, ah, and then nothing and it falls to the ground. So I think IBM is one that I'm going to structure as a critical state trade after an extraordinary move up, adopt a zero state mentality, and then simply decide, is this thing going to go up or is this thing going to go down and play the breakout? Whereas the strategy I would use with Amgen is really I want to try to quietly get in while it's so quiet and just see if I can't hitch my wagon and get drug along before it gets volatile. There's one in here like CRM. It has an index score of 0 and 1, meaning it is at the absolute bottom of its strategic look and at the absolute bottom of its operational look, and it has an explosive volatility z-score of 1.5, which means that this thing is dropping like a rock and is in an explosive sell-off. We call this one the Godzilla Trade, the Godzilla setup, because this is like death from the deeps, and this volatility wave is coming towards you to be great. It's either going to rebound sharply or it's going to fall off the edge of the cliff, and so Godzilla doesn't do anything soft. On the other hand, there's one that may be kind of quiet, like Boeing, which is a 0.14 and a 0.17 and a relatively low volatility. I think of him as a catfish. He's sitting below the surface of the water down here on the bottom, just quietly scooping up all the things that are just floating around down there. And his volatility is so low that this is just an orderly move. That's what it looks like when you have found support, and there may be some moment where this thing slowly comes back up to the surface, almost like a washout pattern. So Boeing, to me, is slightly different than Godzilla because of the difference in volatility. That's how important volatility is on a relative basis. So we'll be developing some more of these ideas. Microsoft is actually almost a catfish. It has a pretty not quiet, it's just in the middle range of volatility, so it's not as interesting to me as Boeing and other catfishes. Like Cisco's more of a catfish. We really want to see this less than -1 to get abnormal volatility. But when you see there's so much volatility, it's hard to get to the -1. So we have to make some seasonal adjustments in there. So more to follow on that. We think there's going to be a number of very interesting niches that come out of that. Okay. I want to stop there so we can get towards the trade frames that the boys put together. Just wanted to give you a preview of coming distractions. Oh yeah, that's the one from the Aussie. All right, so here's Griff's from Friday. This was all of the goodies that included those great big sell-offs. So it's not unusual to see such a good day being contributed by the collapsing dragon. The collapsing dragon is your friend. It's my favorite pattern of all time. Let's see here. All right, into the frames. This looks like a Ken H frame. Alrighty. Alright, so he's got the weekly, daily, hourly going on. Well above the previous trading range, so that's the strength of this move. Except it came back and big time collapse over 2 days, dropping from 51 to 46 and finishing up in this tight little range at 48. So he's taken a nice small inside box here and said, if it's going to rebound, then this would look like a COTA 2 and buying it on sale. But if it fails from here, it should really fail hard and come all the way down to here. And if it fails through here, it's coming back to this, to long-term fair value in the Z3. So this is wheat and precious metals, perfect trade. Remember, if it gets through 48.10, and 46.64, then it's coming back inside that previous weekly range, which would bring it all the way back on an average to down around 43. So this thing could really be suffering. Caterpillar, beauty. What a sell-off. Wow. It went from 235 down to 215. That's a minus 10%. Fire sale on a great American company. If this fails further and breaks through here, you would not be surprised to see it get down all the way to 210. And I hate to say it, 188. That ladder on the downside is painful. It would feel just like that, wouldn't it? But on the other hand, if it held support here, you wouldn't be surprised to see it slowly start marching its way back up to here, and all the way to here. So perfect critical state for this thing that was once great and now suffering. Yeah, Nicole, you asked about the sniper. Yeah, that's going to become part of the sniper package of simple pattern trades. And with that filtering thing we're going to use, we're going to run separate filters for all the different styles of patterns people might be interested in. Try to keep it simple, like for watch users as opposed to watch members. Yeah. We're talking essentially. We're gonna simplify it even more. The A, B, and AC. We're gonna convert that into numbers and say exactly what it means. Yep, that's exactly the system. All right, here is the. We already looked at CAT. Sorry. This is Devon Energy, our little buddy in the energy sector. Has had a, leg 1, leg 2, leg 3, and pulled all the way back from 65 to 58. 15% sell-off. That's how big that move down was, to the very limits of acceptable pullbacks, right? But that means it could now become like this one and get all the way down here. So that's the move you got to contend with. A move down to about 52 from 58. So that's a $6 move on about a 50-cent risk. So that's about 12 to 1. And then from 58 to 65 is $7 on a 50-cent risk. So about 14 to 1. With such a tight little risk, you have to be ready to trade that one in either direction. Tesla. This really held up better than anything on Friday, to be honest. And again, the move down here to 970 is easy to see, and the move to 1050 is easy to see. So that's a $50 or a $30 on probably about a $6 risk or $8 risk. You could even afford a $10 risk and still have a 5 to 1 and a 3 to 1. That looks different than anything else from Friday. The fact that it was able to hold that strong and it has this kind of upward pressure, and it recently was up at 1100. So the trade in either direction is certainly possible. I love that frame. In Elon we trust. Huh? VXX in the volatility space, just beginning to rear its head. So this is not even as volatile as moves to 30 and 40 on a breakout like this. So the upside is the one that you want. The decay, there's not a lot of room for that. So I think I would just be playing the upside. I'd have an entry right here just in case you get that kind of spike, so you get surprised into it, and you don't want to be caught chasing that. This was the isolation. I missed this earlier from Griff for just the CDs, and you should study this as a flashcard. Go to Campfire and download the flashcard. That's 5R on single position trades, just playing one pattern. Here's the starting the series now from Glenn. Nice tight weekly range, ready to go long or short, with clear markers for second and third positions. This would look like a Kata 2 if this broke out and went. Also an emerging dragon. So you'd like to have had that one about 125 in Electronic Arts. And then on the 30-minute, you can clearly see the Kata 2 pattern. This was where if it was going to fail, it should have. It didn't. It just zoomed. So failure to fail is information. Failure to fail further is information. And on a 40-cent risk box, that thing moved $4. That's a 10R move right there. Let's see, Take-Two software and free fall and stabilizing briefly here. A small consolidation area with an even tighter consolidation area on the 1 day, and with a 50-cent risk box. He's saying, well, if that was a fake, then it's going to fail back to here. But if it's true, then it should continue up to here And so with a very tiny risk box, you get 1, 2, 3 to the upside, 1, 2, 3 to the downside, with the possibility for more. And if this failed down through 135 or 130, then all of the people that are short this thing are going to keep piling on. So that's a nice one. Either direction, it's ready to go. Kimberly Clark. Look at that little rebound and huge. They must have found a new pile of uranium somewhere. So was this correct? Is the news good? I don't even know what the news is, but it had to be news to go from here to here with a gap to move that large of a company that far. That's quite a news story. Is it correct? I don't know. But if it fails, it comes right back here on a tiny little $1.50 risk, and it falls $10, which is 6 to 1 on the downside. And if it breaks out to the upside, it's getting to 146. And if it gets above 146, that's free and clear forever and ever. So this is the frame he's got. It's sold off a little bit but held. So if it breaks, he's looking probably for the first move to the halfway down. And then if it starts to recover, you would cash that one and just count your blessings. But it could very easily come all the way back to here. The upside's easy to see too. Clorox has made a nice little rebound in here and closed nicely. A low, caught a two to close nicely here. This is a big gap, so if it keeps breaking out from here, there's no resistance. There is no resistance in here that would slow it down until it gets all the way to here. So that looks like there's another leg up available and a nice tight protective box and a continuation or a failure back to 148, 146, 144. Love that. Critical state framing. Twitter. Talked about this one the other day. Just buy it. And the curve has been made. Closed really well while everything else was getting smoked on Friday. More Elon. It's just hard to see the downside on that one. As long as Elon's in the hunt. A tactical play only. Lastly, Bed Bath. The weekly trade is clearly in either direction, either to 12 or I would say to 24. And so you got about $6 to the upside and about $6 to the downside, and only, a 0.7 risk, which makes this almost 9 to 1 in either direction. This thing was such a rocket that came all the way back to here. Boy, if I was interested on the short side, I might be ready to start getting short at the first sign of collapse before it comes down even to 17. I might try to capture that, but I like 17 as sort of a decisive move. An entry at 17 is a decisive move away from the close. You're giving up 50 cents, but you're still trying to play for $1.50. So if you were very aggressive, you might play a tight box, but I don't mind that large box either. So that feels pretty good. Somebody snuck a couple in here at the end. Luis, yep, thanks. Yeah, my fault on getting that. It was accidentally deleted. All right, let's see what we got here. So this is a spider. Let me see what I got here. So a VIX expiration with the morning settlement. Followed by large sell-offs and volatile moves after. So what this is saying to me is that after a VIX settlement, an option that is correlated with option settlements, you get big moves in both directions. This one featured two strong legs up, but if you have that essentially as a bracket, chance you're going to get paid in this one twice. And then this one again, the big harsh sell-off too. So looking for the correlation in time of these, what I would do is take a look at this, Luis, for the next. This is like the alignment of the planets. When is the next time that these things are going to align? And I would be trying to set up bracket trades from these congestion areas, using the VIX as the trading vehicle. There are now some better structured VIX ETF instruments out there too for the inverse VIX, so you can now play this a little more easily in both directions. Let me see if there was another one out there. Yeah, I think that's all there was. Yep. So I want to come back and show you a couple layouts that I've been monkeying around with in TC2000. They're getting added to the bundle. So this is one that I am calling my 3 time frames setup. So what I've got this looking at is weekly, daily, and in this case just 30 minutes. And what I wanted to show you here was, just while we were here, the importance of this. Let me fill that so you can see what I'm talking about. The importance of this collapsing dragon off the 10s. You get the move. Yeah, so you get the favorable move off the, like an SSC that moves to the top all the way out to Z2, and then it rolls over into the PSAR flip. That's why you got to exit there, and then why you need to pay attention to the collapsing dragon. This is the collapsing dragon on the 10-minute. And you get this move with leg 1, leg 2 accelerating, leg 3 coming into the station. Now, on the daily chart, yeah, let me see how that shows up on the other chart. That's actually pretty cool. On the daily chart, there it is. That red line is this red line, right? And you can see that on the daily chart, that was just like the briefest of hesitations and then a continuation. And what looks like a very clear, a tradable SSC and then a collapsing dragon in sequence is really just a continuation of the next leg down in the dragon. And you can see this vertical crosshair here is where the market opened. That's this one and this one. And then inside of the inside of the weekly, you can just see that's part of we've already had a leg 1, pause, collapsing dragon 2, pause, collapsing dragon 3 is just starting, even though it has come all the way down to the bottom of the box. Look, the bottom of this box here is that's this box. That's the bottom of that box right there, which is also the bottom of this box right down here. So one of the things that I really like about the TC2000 is this ability to get this fractal look at things and see how they kind of play out. The other thing I like about this is, let me open up my little chart here a little bit more for you. This auto framer for me also, or the 3 time frames, I've incorporated some of the auto framer capabilities. So if I want to if I'm looking at my boot camp ones, and I've got this sorted right now by reward to risk ratio, this is the daily trade back to the 10-day high. So I use my center chart for this. So the yellow box shows the daily range from Friday. And the top of the 10-day box is this one right here, that inner box. This box here is the 30-day look back. That's the highest high of the last 30. This is the lowest low of the last 30, which was from Friday. So the 10-day high test is to here, and then using this box as my risk, if I just got a mechanical entry, if it left the box, there is a 5-to-1 reward to risk ratio up to the 10-day high. So that's nice. And then I can sort this whole column of my favorite symbols by reward to risk ratio. Now, if I wanted to play just purely the squeeze, then I take an R-stat move and divide it by my standard risk, which, as you know, is the lesser of the daily range or 1 ATR. So now the one that is compressed the most turns out to be the VIX, amazingly. And it's near its top. But if you get a breakout to the upside or a breakdown below, then the move in either direction is large. Here's what that VIX looks like over here over the last 30 days in this central box right here, right? This central piece is just monkeying around slowly. It just gave us the first warning hint on Friday. And when it makes those big moves, here's the last time it had a great big pop up. And the time before that, it had a great big pop up to 40. And that's just in the last 30 days. So that's pretty interesting. Then on the daily squeeze, that's the squeeziest, followed by USO. Look how tightly compressed this little daily range is. And then, as you can see, he's right in the middle of his 10-day range, which is what I like. This is one of those fence sitter setups where a breakout from his yellow box, there's a nice strong move all the way up to the 10-day high or down to the 10-day low. So he is exactly in the middle of his little range, and it was so tightly compressed, which I know because his reward to risk ratio, R stat divided by my risk, is 2.6 to 1. This is like an ideal little breakout box. So I love that. And now I can set I can see the mechanical entry at 77.50 and the mechanical short at 76.31, and I know that there's a strong move in either direction. I can tell that from just the visual display. And now the big thick blue line is the price that's important to me, which is the 10-period regression line. Look how that thing has oscillated very wide, not as high, not as low, not as high, and then comes into a quiet little station. This is like the train coming in to take on more water, coal, and passengers and cargo, ready to go north or south. I just don't know which way. So I'll straddle that one and go. So this little tabular data over here gives me some very useful information, like computes. If I wanted to get intraday, I could use my risk divided by 3. I could use a sixth of the R stat if I wanted to, and I can find all my data that way. That's in the 3 time frame format. If I wanted to just expand and look at it from the daily bars only, I'm also looking at I was looking at everything in the NASDAQ. Hey, if I wanted to look at everything in the S&P 500, and I wanted to find the ones that had the greatest reward to risk ratio, I might look at CTLT. So here's how you read this one. This little yellow box is his daily range. Look at it, it's right at the bottom of the 10-day, 30-day, and 150-day look-back period. If that thing collapses, look out below. But if it holds, like it did here, there's a move up to 115 available. So you would call that a critical state, wouldn't you? I would. And here's all the information on the tabular. Now, Netflix, also horrible. So I've sorted this one by reward to risk ratio, and what that's going to do is put near the top the ones that have the greatest move available back up to the 10-day high. But that also means that if they collapse through the mechanical low, the mechanical stop, then chances are that whatever made this thing horrible is continuing, and that makes it a good stop and reverse. Here's Pfizer. Now, Pfizer's interesting because it's in the middle of its long-term look back, but at the bottom of its 10-day and 30-day with a range compression. So it has 5.5 test of the 10-day high and a 1.6 if it just makes a breakout of an average of a range stat move. PayPal. So I can just go through these and look for... Boy, if you're not interested in PayPal as a collapsing dragon all over the place, I don't know what else I have to do to persuade you that that's interesting. But if I look back even further, holy mackerel, all of the goodness that Netflix ever was is now lost and forsaken. And if it breaks down from here, look how far back you have to go before this is ever back to, I mean, what a shattering of billions of dollars of market value right there. But all I care about is there may be some meat left on the bones to pick. Let's see if there's anything else I read. Oh, there's Travelers from the S&P, or from the Dow 30. Perfectly located in the middle of its 150-day look back, but at the bottom of its 30 and its 10-day. So you don't have to think very hard to see that this thing could break down and come to 168 and rejoin, the support level here. So if it breaks below here, it's coming to here. And if that fails, it's coming all the way back to here. So you can use visual trading and tabular data like this to isolate on the patterns that you really like the most. The auto framer and the 3-day or the 3 time frame is a preview of coming attractions. Thought you guys might be interested in that. Let me also show, now I went through some of the different patterns that I really like the fireworks, Humpty Dumpty, catfish, Godzilla, the fence sitter, and the barbecue. And just snipped out a few that I wanted to share. So this is an example of the, let's see, this one was, let me come all the way back into here. I'll start at the beginning. So this one is Pfizer, which I really like, and you can see the Pfizer data. I was interested because it was a 5.5 to 1 on the reward to risk to the 10-day high, but also 1.6 to 1 on the breakdown. Plus, it's very liquid. So I like that one as a breakout, like in either direction, like from here. I'm ready to go either direction from that zero state. This one was CTLT. Never heard of them, but man, that is just such a collapse in every time frame that if that breaks, you wouldn't be surprised. But if it rebounded, there's some nice moves to the upside that a savvy trader could get to. Now, here's the advantage of looking at individual equities, right? A lot of folks will say, hey, you know, the currencies, there's only a handful of them. Yeah, but everybody watches them. And it's hard to find a personal edge, or maybe not, if you look at 61R from my brother. But these ones that are out on the periphery, there may not be active traders looking at them as a critical state. So you're coming into a point where all the long-term hands on this thing are in a heightened emotional state and might be chased out one way or the other. Yeah, Ed says, can the new patterns be used in all the systems we have? Absolutely, because all these patterns that I'm just describing right now are simply ways to identify a critical state that is ready to move in either direction. Some of them are going to be near the tops of their ranges and breakouts, like fireworks. Some of them are going to be like this one, which is a Godzilla, which is a C on the long term, a C on the short term, and extremely volatile, that finished up in a tiny little wrist box. So this is like death from below. If it rebounds, it's like Godzilla coming out of the ocean. And if it fails, this thing is just going to go to zero because there's no support levels in sight. So you can trade that with all of the other particular patterns that we have, like the collapsing dragon and the SSCs. This is just a way to find something that is predisposed to make a larger than average move in a shorter than average period of time in either direction. That's what makes these so darn powerful. Like, you might want to just specialize in things that look like this. So you can actually scan the S&P 500 and find the top 10 things that look horrible on every every look back period, and have compressed into a quiet little one-day doji. That may be your ideal setup, and from that you want to trade your intraday patterns. Well, why not start with something that is already predisposed to collapse big or rebound big, because he's such at an extreme location and is in an abnormal volatile state. So all we're trying to do here is start with better raw material. Better raw material. So Netflix was one I was interested in. That's like that again. This one is like a catfish. It's so quiet and at the absolute bottom that it's feasting on corpses. It almost. But if that breaks down, I mean, look out below. We saw that one already. This is the opposite one. This is Nielsen, and this is a fireworks to me. This thing had been monkeying around down here, had the first boom and then a second boom, and now the last 10 days hasn't done anything except drift down to the very bottom of this little shelf. This is actually what I would call like Humpty Dumpty, because if that thing fails, couldn't you easily see it come down this far? That would be an amazing move. Very tradable with a very small risk. That's 1, 2, 3, 4, 5, 6, probably 8 to 1. But if it moves out to the upside, you could see how this thing could become a trade like that. So you have a very small risk box, the possibility of a large move in either direction. You get started well, and then you use our standard management techniques, intraday and through swing trading, to manage those positions. Like, for instance, what you can see down here is that you had an oversold oversold conditions. So what we're really doing is essentially waiting for, wait for it, an uptick from the on the MACD histogram. As soon as that's an uptick, we have a WMB3 to the upside on a daily chart instead of a 1 minute chart. So there's some possibilities on Nielsen. JB Hunt, I like this one because, like a catfish, it has floated down to the bottom of his little pond there, and it's just, it hasn't failed any further. Oh, sure, there was a massive sell-off in here when everybody was concerned about the reduction of global trade, and then the long-term, the long-term normal got violated, but now it is terminated in this nice tight little support range here. Now, this is either going to rebound from here. Here's leg one. And then if leg one holds, you can see how it could get back up in here in a couple more legs. Or if it fails out of here, this thing is going at least down to here. So there's a nice trade developing out of the 1 day range on JB Hunt. Right. Visual box trading, but applied to daily charts. Now, how do I find these? Well, you just set up a standard scan and structure like this tabular data, sort it by the reward to risk ratio or the daily squeeze. This one was because it was a daily squeeze of 3.6. That range was so tightly compressed, like a coiled spring, it would be amazing. Here's one, Micron Utilities. This is a semi. I like this this one was a combination of a nice reward to risk on the auto framer, but also on the daily squeeze it was 2.5 to 1. So there were two good reasons to like that one. Coiled spring, and at a trade location where this move that comes out of here could test the 10-day high or collapse further. I like that one. So it's actually pretty easy to find the kinds of trades you like once you structure your filters and searches, and then just decide which of these different style patterns you really like. This one feels like a Humpty Dumpty to me because he's had a great rise, and now he's sold off a little bit and hovering on the edge of collapse. And if he fails, there's going to be an omelet all the way down here. So that's a big move. But if he recovers, he has a nice little move to the top of his 10-day high. It's only 1.7 to the upside, but the fact that he's ready to collapse right there makes it very attractive to me. Humpty Dumpty. If he fails, it's a great move to the downside. Here's one. Amgen has a relatively quiet range these last 10 days at the end of a nice long run up on every time frame. This thing is great on the 150, the 30, and the 10, although the 10 has pulled back. So he's in a state of indecision right here. What's it going to be? Is this going to be the start of a collapse and then a collapse? Or is this a chance to recover back to the 10-day high and beyond? Like, you wouldn't be surprised if it went above 260. At that point, all fear would be gone. So this really looks like a breakout buy. So this yellow zone is an alert to something that is postured to make a really strong move in either direction. So I do a bracket trade on that like this. I'm ready to go long or short with a relatively small risk box. And that's just on daily chart. That's how you set up a swing. Tesla, to me, is the fence sitter. Look at this thing. Right in the middle of his 150-day look back. still relatively in the middle of his 30-day look back and right in the middle of his 10-day look back on a relatively small kind of a range. This is perfectly poised to break down or to break up. And if he breaks up, would you be surprised if he did this? To do that, he's got to break above, see, the 10-day high, 30-day high, and the all-time high. That's what that trade looks like. And then the breakdown says, well, there's the daily low, the 10-day low, probably here, and then probably the 30-day low. So there's a strong move in either direction that's ready. Facebook. Oh, Godzilla. This could be screaming disaster if it fails out of all that. And then there's a tactical trade to the upside just as a recovery from disaster, from the edge of the cliff. That's this trade where he gets to the 10-day high, to the 30-day high, and then it's a question from here, is it going to go up and recover that gap? That would be surprising short term, but long term, who knows? But there's a tactical trade in both directions on Facebook, ready to go. And look how tightly compressed let's look at how tightly compressed that daily range is. That's a really, even though it failed, that's a really small range of the day compared to these big sell-off days. So maybe it's going to hold some support somewhere around north of 180. I don't know. But if it holds support, there's going to be a bunch of people who want to buy it on sale. That's a 30% move back up to 240. So tactical traders are watching. When was the last time it was down here? Oh, it did that last time. You're not allowed to be surprised if it does that again. It's already done that. It would look just like that. In a matter of about 10 days, you would think it could get back to 240 if that's where it was going to go. I think the last one, Zoom. Zoom is odd to me. Wow. You would think that with the opportunity to monetize that they would have done a much better job than letting it come all the way back to here from the peak of almost 600 down to 100. Who's running that show? That's minus 80% sell-off. That's brutal. Can't be anything good there. Oh, except for the fact that it's now given us this tight little consolidation zone. Maybe that's the consolidation zone that predicts this. That's what everybody that wants to buy it believes. I just want to trade it. I just want to facilitate market movement. That's all I want to do. But Zoom Communications should be of interest to us. So let's take a look at that rascal again. Look how nice and tiny that little compressed range was. Oops. Well, you see what I mean. I don't want to spend too much more time on this one. All the way back down here to Zoom. That little yellow box is a tiny little range compression, and it's already, the last time it was down here, made this move. So a move back to about 130. That's a 30% move off of this price. So if you're not looking at Zoom as a candidate to either fail large or gain large, then you don't really understand shorter term trading. That's what an opportunity looks like in Zoom. Okay, perfect critical state. So what I just wanted to share with you was a couple new patterns and new frameworks and frames of reference to allow us to get into niche trading a little more easily. Okay. So that's everything I got for you tonight. Thanks for hanging in there. It was a little bit longer than usual.